Ever wondered how businesses improve their cash flow? One way they do it is through factoring. Now, you might be wondering what exactly is factoring. Well, it's a financial transaction where a business decides to sell its accounts receivable, or in simpler terms, its invoices, to a third-party financial institution known as a factor. And they do this at a discount. Now, why would a business do that? The answer lies in the immediate need for cash. Instead of waiting for their customers to pay the invoices, businesses can receive a substantial portion of the total invoice value upfront from the factor. This process gives businesses instant access to cash, which they can then use to finance their operations, pay their employees, invest in growth, or meet any other immediate financial needs. But what about the invoices? Well, that's where the factor steps in. The factor assumes the responsibility of collecting payments from the customers mentioned in the invoices. So, in essence, the business is transferring the risk of non-payment to the factor, along with the task of invoice collection. Let's illustrate this with an example. Suppose there's a small business that sells $100,000 worth of products to various customers with payment terms of 30 days. Instead of waiting for 30 days to receive payment, the business decides to factor its invoices. Now, a factor might offer to pay, say, 80 to 90% of the invoice value upfront. This means the business can get between $80,000 and $90,000 immediately. Once the customers pay their invoices, the factor collects the payments and deducts its fee before remitting the remaining amount to the business. So, that's how factoring works. It provides businesses with instant access to cash and transfers the responsibility of invoice collection to a third party. But remember, factoring is just one of the techniques businesses use to manage their cash flow. In the next scene, we'll talk about another technique called forfaiting and how it differs from factoring. Now, let's focus on another financial technique called forfaiting. Forfaiting is a specialized form of trade finance where a forfeiter purchases the receivables arising from the sale of goods or services on a non-recourse basis from an exporter. This means that the forfeiter, not the exporter, assumes the risk of non-payment by the importer. Let's visualize this with an example. Suppose there's an exporter in the United States selling machinery to a buyer in Europe with a credit period of 180 days. To avoid waiting for the buyer's payment, the exporter can opt for forfaiting. A forfeiter agrees to purchase the exporter's receivables at a discount, let's say 95% of the invoice value. This provides the exporter with immediate cash, allowing them to finance their operations without waiting for the buyer's payment. The forfeiter then takes on the risk of non-payment by the buyer and collects the payment when it falls due. Now that we understand both factoring and forfaiting, let's outline the key differences between these two techniques. The nature of their transactions sets them apart. Factoring involves the sale of accounts receivable to obtain immediate cash, while forfaiting involves the purchase of export receivables on a non-recourse basis, often in international trade. In terms of recourse, a factor may have recourse to the seller if the customer fails to pay. On the other hand, forfaiting is typically non-recourse, meaning the forfeiter assumes the risk of non-payment without recourse to the exporter. Lastly, the term and geography of the transactions also differ. Factoring is often used for short-term domestic transactions, whereas forfaiting is mainly used for long-term international transactions. While both factoring and forfaiting help businesses improve their cash flow, they cater to different types of transactions and businesses. Now you know the difference.